Budget 2024 has happened. So what are the implications for you and your business? Let's take a dive in today. Hi, I'm Kimberly Shapcotts, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. On the 30th of October 2024, Rachel Reeves delivered the first Labour budget in 15 years. Their pledge was to invest, and they've looked at raising £40 billion in their budget. But what does that really mean for you and me in our small to medium-sized businesses and our property investments? Well, let's take a look at what they've said in the budget today, to go through all the different areas and then check out some of the more specific videos so you can find out about more on the capital gains tax, the inheritance tax, the stamp duty, employing people on the channel as we dive into more detail as we really get into how this is going to affect our businesses. On this update, let's start with the personal tax side of things on that basis. So from a personal tax point of view, there have been no changes. We're still at 20% and we're still at 40 and 45%. And all the allowances and the thresholds have stayed the same at this point in time. However, as of April 2028, they are going to start moving. Therefore, at this point in time, there's no changes to what we need to be doing from a personal tax point of view in terms of the planning of how much income you can be earning before you're paying the different rates of tax. As of April 2028 though, our personal allowance, that $12,570 we currently get, is going to be moving and it's going to be increasing in line with inflation. That's going to give us a little more money in our pockets and less tax to pay. However, we will still be taxed at the moment, based on what we know, at the 20% for anything over that personal allowance. There's been no mention of the other thresholds, so potentially this just means that the personal allowance will increase and we'll pay a little bit less tax at the lower 20% rate or appropriate rates, and we'll just get into the 40% and you'll pay 40% at a similar sort of value of the $50,270. The marriage allowance is one to mention as well, as it's a useful allowance for those that are married, especially if one of the couple is not necessarily fully utilising their personal allowance, and is one where we can pass 10% of that personal allowance from one person to the other person that is in the marriage. Now, this can be a great way, especially if you've got one working and one who's not working as much, or maybe they're taking the brunt of the income from one thing and the other is not got so much income. Maybe they are on the property rentals and they only get $6,000-7,000. They've got some capacity to pass their personal allowance to maybe the person who's still working full time. Now, one key thing to just mention here today is that if you haven't made use of these allowances, you can go back and claim this allowance. However, if you're looking at going back as far as 2020, 2021, you need to get that claim in before the 5th of April 2025. So if you haven't made use of this allowance, you look back and you go, we could have made use of this, then do check it out, have a look what you need to do, as you may be able to get up to, it's around £1,000-1,200 tax-free that could be transferred across to save you some tax over the last several years. The tax on savings income has not changed, so we still have £1,000 that we have for anyone in the basic rate tax band, and we have our $500 at 0% for anyone in the higher rate of tax. It should be noted that there is a allowance of $5,000 for those that have very little income, and if your interest is the higher amount of income that you receive, then you may be able to make use of this up to $5,000 allowance, depending on how your income is fit together. So do check that out if you have very low income, if your other non-savings income is less than £5,000. So there's a few bits there that may be useful depending on your sources of income at this point in time. On a potential win for our dividend tax income from the budget, we do find that they have not changed, and this is a bit of a win because there was that question mark of whether they would look at increasing these and increasing taxes to collect some of that money that they were hoping to collect. But it is not from this source. So we still are down at our 500 allowance, which I appreciate is probably neither here nor there in the grand scheme of things. But we've got a £500 allowance and our tax rates are still at 8.75% for our 20% taxpayer, 33.75% for our 40% higher rate taxpayer, and 39.35% for our additional rate taxpayer rather than the 45%. So there is scope here that we can still be doing some planning with our dividends to try and minimise or maximise the money out, minimise the tax, to make everything fit together for you and your tax position. As a follow-on from that point, we should just mention that if you are overdrawn on your director's loan account in your company, there is still the Section 455 tax which is payable, and that is still at the 33.75% tax rate. So if you are overdrawn, then you may just need to make sure you are managing this position. As always, these things could change in the future. Let's talk a bit about pensions then, which I know is not one of those topics that we talk about for property, but they do have their place and there is some uses of them in certain areas. So our pension allowance is still at the 60,000, which is a great amount of money, especially if you're making some good profits in your property business, and could be a way of moving money around to get you sources of income in different places, especially if you're using things like SASs. It should be noted that if your income is at the threshold, and the threshold income of over 200,000, then your pension allowance is restricted and reduced. So you just need to be cautious on this area to make sure you're not putting in more than you're actually allowed to put in. The tax-free lump sum has also got a confirmed limit, which is basically the 25% of the lifetime allowance before the lifetime allowance was removed, which has still been removed, and they have not reintroduced this at this point in time. That is based on a limit of 1,073,000 and the tax-free lump sum, the limit of 268,275, which I appreciate is a very specific number. In terms of the individual savings side of things, we still have our ISA allowances, our individual savings allowance of 20,000, our junior ISAs of 9,000, our lifetime ISAs of 4,000, and our child trust funds of 9,000. So these limits are still there and are still available for making use of if you have any spare funds to be putting into different ISAs for appropriate persons. The high income child benefit has had some changes come to fruition, and as of 25-26 tax year, the limit before you start losing it is going up to 60,000, and this limit will extend so you don't actually lose it all until you are over 80,000 income. Unfortunately, the government have not moved forward on the plans that the Conservatives brought in to look at basing this on a household, so this is still based on an individual person at this point in time. So if one of the couple who are in the household earns a greater amount, then the child benefit potentially will be lost. Please note that if you are getting child benefit, then it may still be worth putting your name down for child benefit, as you do get the pension stamp by being on the child benefit list. So it may be still worthwhile getting that child benefit take, even if one of the couple are earning greater than that amount, just to make sure that you get your national insurance stamp for the duration of that child up till their 16th birthday to get your full pension, state pension, at the end of the day. What has happened with employment then? So the employment taxes and national insurance have gone through a few shifts. From an employee point of view, the national insurance hasn't particularly changed, and we're at 8% for our national insurance at the moment. Now, the employer side of things, which was at 13.8%, has now shifted to be 15%. So that will be introduced in April 2025. An additional point to note is that normally the employer's national insurance kicks in at a certain income threshold for an employee, which was previously 9,100. However, this limit has been reduced down to 5,000. So as soon as one employee earns over 5,000, that employee will suddenly have employees' national insurance to be paid at the 15% tax rate. A further amendment in this area is the employment allowance. And the employment allowance is basically an allowance towards your employer's national insurance. So this is really aimed at helping smaller businesses to take on staff so that they don't have the burden of the employer's national insurance side of things. This limit was $5,000, and this was restricted to certain businesses who ticked certain eligibility criteria. In the recent budget, the eligibility criteria has been removed, and it is now available to all businesses, as well as being increased from $5,000 up to $10,500. This is in effect expanded who it is to all eligible employees. So this may help in terms of getting those first few employees before you do start having to incur the additional employer national insurance expenses. National insurance on the self-employed has not changed, and we are still at the 6% rate up to the higher rate threshold and 2% afterwards. This will be remaining the same into the 25-26 tax year. There have been some changes to the lower employers limit and the small profit tax threshold. So there have been a few other alterations in this area. Check out the newsletter on the channel in the community section to find out some of the specific details. We've also got an increase in the Class 2 National Insurance contributions up to £3.50 per week. And the Class 3 rate for the voluntary contributions is £17.75 per week as well. For national insurance, the final bit to mention is they have also extended the veterans' no employer national insurance allowance as well. So this means that if you are looking at employing some veterans, that there will be no employer's national insurance up to the 50,270 threshold. So this is a great way of, if you are thinking of employing someone and you do know a veteran and you think they may be great for the role, they may be a good for the business as well, because it will help keep any employment costs down to a minimum as far as possible. National minimum wage and the national living wage have all increased, with the national living wage now going up to £12.21 from April 2025, and appropriate changes for the 17 to 18, 18 to 20 and apprentice rates having increased as well. Anyone with company cars, there have been some slight increases to the benefit in kind for company cars. Those with the zero emissions vehicles are moving from 2% up to 3%, so there will be a slight increase in the tax charge for having your company car, yet still quite tax efficient in a way of having a vehicle through your company. The charge on all other vehicles, so any petrol or diesel ones, have also gone up by 1%. However, the maximum amount that you'll be paying is 37%, and that remains the highest level that you will be paying on this type of benefit. The car fuel benefit charge, if you are having fuel as well as a company benefit, will also be going up, and this will be going up by the Consumer Price Index from 2025-26 tax year. So this will be moving in an upward direction going forward. One that has been debated many times is the double cab van or vehicle, and whether this is a car or whether this is a van. From the 1st of April 2025, all double cab pickup vans will be treated as cars for capital allowances, benefits in kind, and some deductions from business profits. So as of April the 6th or April the 1st, depending if it's in your own name or in a company name, these will all be treated as cars. If these have been purchased before this date, then they'll be treated as they have been treated in the past. And then there are transitional rules which will need to be worked through to make sure that this fits together. So there will be a separate video on this area, as it is one of those quirky areas that I know we have got some people out there who they're useful vehicles, especially in our property sector, where we have to move things on a regular basis. So we need a practical vehicle for our business, but maybe also want use of a vehicle for our home life, our family life. Company vans, where they are actually a company van, now these will be increasing as with all these different benefits, and this will be by the CPI, the Consumer Price Index, from April 2025. So this will be moving upwards, but obviously not massively, as the consumer price index does vary up and down by several percent each year. In terms of the benefits in kind that we see, the government is also looking to mandate that this all starts going through the payroll. So we'll start seeing this from April 2025, and the mandation is coming into play, and we will see exactly what they're going to be doing when, and as these things come in, we'll be making sure we share that news with you so that you can make sure any benefits you do have are going through the payroll or going on your P11D as appropriate, to make sure you are compliant with any tax rules. For those working for umbrella companies, there has been some changes in terms of how those umbrella companies are working, because the government are looking at tackling non-compliance with the appropriate tax rules. This should not affect anyone themselves unless they are operating an umbrella company, and there may be some changes that you need to look at. But for anyone who is working for an umbrella company, this shouldn't affect you particularly. This is more aimed at the umbrella companies to make sure that they are doing things in an appropriate way. Let's move on and look at some business tax side of things. So from a business tax side of things, we have got no changes to our corporation tax rates, which is great news. So we know we're sticking with the 19 and the 25%. We know we have the marginal rates based on the 50,000 for a company and the 250,000, which means all the associated company issues that we have been talking about are still relevant, and we still need to be considering this side of things. At this point in time, there looks to be no intention of increasing that 25% rate, so that looks like the top rate that we are going to be looking at this point in time. Capital allowances, they have continued with the full expensing allowances and the annual investment allowance of £1 million, which sounds an amazing number. However, unless you are buying any particularly big kit and equipment, it's probably not going to impact too many of the property investors watching this video. Obviously, as an investor, we can claim certain things through our annual investment allowance. However, a lot of the things through our properties are a bit more limited on what we can be claiming. So this is great news that we can still be expensing and doing these different things. However, probably limited in scope for anyone in a property sector area. Let's have a quick look at furnished holiday lettings then. And the abolition is still coming, and it will be happening in April 2025 to make significant changes. So if we look at a few of the different areas of how these changes are going to look, this hopefully gives you a current update on this aspect. Now, from a pensions point of view, individuals will not be able to make use of this income as part of their UK relevant earnings, which means it may limit what you can be putting into your pension. So you just need to monitor this if this is the income you are using to enable you to put into your pension. For your dwellings related loans, so your mortgages or your private loans that you have on your properties, this will no longer be fully allowable, and it will move on to the finance charge as any other normal residential lettings will be. So therefore your income will increase even if you've got a lot of loans on it. So it may take you into the 40% tax band rather than simply in the 20% where you will have been when your mortgage interest will have been allowable as an expense. So this is just something that we can look at exploring and dive into from this point of view over the next couple of months to ensure that you are happy and confident with this area. At present, you can use capital allowances to use for any of the assets that you're purchasing. Unfortunately, that will be stopping. There is transitional rules in place for any item that is purchased before that date, but anything after that date will be on the domestic replacement relief, which you can check out the video on the channel to find out what that's all about. But you will only be able to claim for replacements, and you won't be able to claim for the original or the capital allowances side of things. From a capital gains tax point of view, there will be some reliefs that are now no longer available. So disposing of your business may have a slight change going forward. Rollover relief will no longer be available as it is no longer a trading business from the capital gains tax point of view. However, there is some business asset disposal relief transitional rules which may apply in certain circumstances. Therefore, if you are thinking of doing something, I'd suggest that you speak to your accountant to see how that fits for you and what impact it may have on any disposal that you are making. And finally, losses. Losses, any unused losses will be able to be used against other property income. So it has expanded this to allow a little more freedom rather than limiting it just to the same trade, on the basis that now that trade is property income. And this will enable you to carry it forward to make use of it in the future. Business rates will be changing as well, and the relief will be going to 40%. So that is a reduction in the relief that businesses are getting at present. So this is for the retail, hospitality and leisure industry, and that will be restricted to 40% with a maximum of 110,000 for businesses. Let us move over to capital gains tax then and see what changes have been made here. And in some ways we've got a lot of good news here. They didn't go crazy and start making any big changes, which obviously from all our point of view is a win. However, they have moved all the capital gains tax rates from the previous 10 and 20 and 18 and 24. So now everything is 18% and 24%. This applies to everything on or after the 30th of October. So that was a budget day change. So any disposals after this date will implicate that the tax rates are slightly higher, unfortunately. As a precursor to future budgets, I would say if you are thinking of selling something, you may want to be selling it before the next budget. The reason being, now that they have one rate of capital gains tax, the question mark is out there whether they will increase from the 18 and 24 up to the 20 and 40% in the next budget. So if you are thinking of buying or selling something, then you may want to be getting that sorted sooner rather than later, so that you don't find that any tax rates have further increases in the future. The annual allowance of $3,000 is still in place, and that has been confirmed for the 25-26 tax year. So we are still working with our $3,000 allowance, which again is not a lot, but obviously everything helps to reduce our tax bills. For those with businesses where business asset disposal relief applies, there is good news and bad news. The good news is we still have this allowance, this relief for those that have built their businesses and can sell it and make use of the business asset disposal relief. However, the rate currently is 10%, and that rate applies up until the 5th of April next year. After this date, we have got the rate increasing to 14%, and then the year after that, it will be increasing to 18%. So it kind of is moving to the lower rates, the 18% being the capital gains tax, lower basic rate that is payable. So it's a positive that it's still not at the higher rate for the first million. However, it is obviously increasing. So if anyone was thinking of selling their trading business, it is probably a better time to do it within the next 12 months to make sure that you are paying the lowest possible tax rates, if that fits in with your timings. In addition, there is also an investors relief, which had the first 10 million as allowable at the different lower rates. This allowance has been reduced down to $1 million, so the first $1 million of any investor relief is now taxed at the lower rates. However, we've now got a much lower amount that can be used, 10 million down to 1 million. So there is some restrictions in terms of these sorts of reliefs available, which was semi-expected, but we will no doubt see more reductions in the future. So if there is any things you're looking at getting out of, it may be the next short while is the time to be considering that, to just make sure that you're not finding you lose the relief entirely should that happen in the next few budgets. Let's move on to our inheritance tax side of things then, and what changes have we seen here? Now, for one, it is still here, so we still need to consider an inheritance tax as a planning side of things. But the 325,000 rate is here, it's here to stay, and we're going to be seeing it all the way through to 2030 because it has been frozen. The additional nil rate band has also been frozen at the 175,000 up until 2030, and the relief is tapered for any properties that are over 2 million, and that has not changed, and this is all staying the same till 2030. So We've got quite a lot of planning time for anyone who may not be with us. Up to that point, we know where we're going, and anyone who'll be around a bit longer than that, which hopefully is a lot of people out there. There may be some changes in the future, but at the moment we know where things are going, so we know what planning we potentially need to do in this area. A big change that is coming in 2027 is that any unused pension pots will be being incorporated into your inheritance tax, so they will become part of your estate. So some of the planning in the past has been leave it in pensions, it's outside the scope of the inheritance tax and some of this area. Whereas for that side of things, this is going to be changing, and this will form part of your estate going forward. So there may be a little bit of planning around this area, depending what pension pots people have sitting in the background that they were expecting to leave to their families. One of the big changes that they did make in inheritance tax was all to do with business property relief and agricultural property relief, which for many people may not be a big thing. But anyone who does have a trading business, so you may have a property investment which doesn't fall within this box, but you may also have some sort of trading business that is sitting alongside your property investment portfolio. That business now is restricted to 1 million allowance for this 100% business property relief, which means if your business is worth 5 million, you're now going to be paying inheritance tax on 4 million of that. If your business is only worth 1 million, you're not going to be paying any inheritance tax on it. So there may need to be a bit of planning around this. And also for agricultural property relief, this has also been incorporated. So a family or an individual only has 1 million each. So for anyone with agricultural land, there may be a few issues and a few planning points that need to be considered from this point of view to make sure that we do not have issues and inheritance tax being paid when maybe it doesn't need to be, or it could have been structured in a different way. Check out the video on inheritance tax, because we're going to have a bit of a dive into that one to hopefully have a look at how it all fits together. A few other matters then. So VAT registration limit has stayed the same. Not an issue for a lot of businesses, but anyone with furnished holiday lets, there's been no mention of VAT. So as it stands at the moment, you'll still need to be registering for VAT when you get over the VAT threshold limits, unless you're using the TOM scheme, where we've got no current update as the cases haven't gone to court yet, and we're just waiting for outcomes on how that all fits together. That is being added to private school fees going forward. That came in earlier in the year, or was mentioned, so a lot of the planning or ideas there are not coming into play. One thing to probably just mention is to say, if you are a VAT registered business, it does not mean that you can reclaim the VAT on your school fees, because they are not wholly necessary and exclusively for business purposes, which therefore means that the VAT is not reclaimable, it is a restricted expense. Moving on to stamp duty, and they threw us a bit of a curveball as investors, as they've now changed the 3% rate up to 5%. This was for any completions as of the 31st of October onwards, so that means anything that is completing now will have a slightly higher rate of stamp duty to pay. Check out the separate video on the stamp duty side of things, and we'll just have a look at what the figures are going to be going forward, so everyone's got an idea of what they need to be putting into their calculations to see if a project's done and to work out what your final offer is going to be on a property. Making tax digital is still coming, and they have confirmed that this will be the case and that we will be seeing that introduced in 2026 and 2027, and there is something that is going to be happening for anyone with income over 20,000. We've got no information about the 10 to 20,000, but there has been mention of the 20,000 limit, so we will be needing to do something with that. There is a number of other things from the budget, but they're very specific to multinationals, to creative industries, and a whole different thing, as well as HMRC are looking at doing a variety of different initiatives to ensure compliance and simplify things from their point of view. But hopefully, with all of that information that I've gone through over the last little while, you can see that there's been quite a few changes, but also quite a lot that stayed the same. So now check out some of the extra videos on the channel, which will go into some of the calculations, show you some of the numbers, so that you can see exactly how this is going to be affecting you and your business. as far as budget goes, it's not been too bad, but we are into the new Labour government and we will see where things go. This has definitely been more of a impact on those that are creating wealth, who are business owners, that are employing people. So there is definitely a drive towards minimising those that are creating income for themselves. So it's now just managing these changes in the tax rules to make sure that you are maximising what you can get out of your business in the right way at the right time for you. Hopefully that gives you an idea of what has happened in the budget and how it's going to impact your business going forward. Check out the more detailed videos on some of the different areas like capital gains tax, inheritance tax and stamp duty that are coming in the next couple of weeks. Please like the video and do subscribe to the channel, and let's make tax less taxing. Let's make tax less taxing.